training with the mortgage calculator. Today we're going to be talking about calculating the blended rate, so first and second mortgage rates. So we will wait just a minute here to get started. Let us go live on all the different platforms. We did put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. We appreciate everybody tuning in from all the different platforms: Facebook, YouTube, LinkedIn, Spotify, Apple Music, anywhere you can stream, we are there, and we appreciate everybody tuning in. Remember that we do this at 7 p.m. Eastern Time every Tuesday and Wednesday evening, where we go through a different either loan type or strategy or other type of training for loan officers. So I see some comments coming in there. Appreciate it, everybody. The chat is up on the screen, so feel free to keep dropping comments in there. Also, keep in mind you can drop questions in the chat as well as we go through the presentation here. So with that being said, it looks like we are all good to go. We'll go ahead and get it started. Keep dropping comments there and questions in the chat. We can answer them later. So welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is go through a new loan officer training. So our sales manager, Jose, with 28 years of experience as a loan officer and a realtor, is going to do a deep dive into a training today. And today's training topic is calculating the blended rate. So second mortgages, very hot right now in the market that we're in. So this is definitely a training that's pertinent to right now. So I will let you go ahead and take it away here, Jose. Let's talk about second mortgages and blended rates.
Good evening, everybody. Thank you for joining us for tonight's training. At the Mortgage Calculator, we love always being at the forefront of everything that's happening, right? So we like to stay ahead of the curve. And we have been emphasizing for quite a few months now second mortgages, different second mortgage products that we offer. HELOCs, which are open-ended mortgages where you pay interest on the amount that you owe. Excuse me. HELOCs are, due to their open-ended nature, are variable rates, typically, are a variable rate product. And lately, variable rates are something that have to be given additional consideration when selecting that product. Hence, we also have the HELOAN, which is a fixed rate, closed end second mortgage that we've offered that product in the past. The HELOAN advantage is, besides investors being investor friendly, is being income alt doc income friendly. Let's put it that way. So we have our full doc option, bank statement option, P&L option, and even DSCR options for the HELO. So obviously that's always something to consider. Strategy is still the same when we're talking about blended rates, just different product offerings depending on the borrower's needs and objective. So then we have our newest offering, which is I'd say like a hybrid program where it is a HELOC program, but it is fixed rate, right? The rate is fixed per draw. So when you do your initial draw, it's going to be at that rate. And then when you do a subsequent draw, it's going to be at whatever the rate is at that time. And those rates those rates are independent of each other. So it's an interest rate per draw. There is a certain draw period. Then after that, no more draws. But you can see the benefits to this program in terms of locking in a rate that you can then do a little bit more planning with. So it's a good hybrid product, and it does come with additional benefits of lower closing costs, different originations that are available. So in the examples that I'm going to be including in today's presentation, we're going to be talking about an origination cost of 1.99 points to get to the interest rate that I'm going to be using in the examples, right? That is why it was so important because we just launched the product and we really want to make sure that that everyone understands how to apply it both from the loan officer point of view and from the borrower point of view as well. So, and as you can see in the title, where we're talking about maximizing the borrower savings by our blended rate analysis. That's really what this is all about. So, so blended rates definitely are the thing now in this rising, or should I say, volatile rate environment. We have a lot of borrowers that may have really low interest rate first mortgages that do not want to really have to touch that loan. And we're going to leave it alone. It's 3.5%. 3.5% is the rate I'm using for any examples also in today's presentation. So the good thing about the blended rates is that you're really looking at the proportionate amount that each loan is adding to the overall interest payment. And in doing so, then you get obviously the blended rate. A lot of benefits here. Customer can maintain the existing amortization schedule on the first. Besides having a lower rate, a lower interest rate also has a more favorable amortization schedule, meaning the amount of principal versus interest that's going into each combined payment is higher amount of principal than at a higher rate, which would be less. Besides the fact that amortization tables are all heavily front loaded, so the majority of the interest is collected in the beginning of the loan. So if you had 3, 4 years, 5 years on a loan, now you go back to zero. That's also something you have to take into consideration when doing any benefit analysis that you do. So definitely a lot of different considerations as loan consultants to take when you are trying to provide the best guidance to your borrower. So blended rate is the weighted average. We're talking about proportionate shares of the interest rate on 2 or more loans. So you see there in our example, second mortgage is a smaller piece of the pie than the first mortgage. That's the key here because that existing first mortgage is going to be at a lower rate. In this case, we're using 3.5% as our example, and our second mortgage is going to be at 11.75%, right? So, and here's where we get to the defining moment is the formula for calculating the blended rate. Now, mind you, yes, there are many blended rate online calculators. I'll share one with you at the end of the presentation. But it's key that you understand how it is derived so that you can understand the concept and be able to better convey it to your borrower. That's the key here. If you understand and are confident with what you're explaining, it will come across accordingly. Your customer will feel the love, will see that you know what you're talking about, and will appreciate how you're looking out for their best interests in going for the smaller loan, mind you, because you got to understand Some predatory lenders out there might just want to go out for that big loan and just want to say, hey, let's just refinance the first and not give you any other options. But we'd like to give those best options and then empower the customer to let them decide. But in order to do that, you got to understand what's going on. So in this case, we're talking about calculating the proportionate share of the interest rate for each loan. And if you're talking about rate one, which in this case is 3.5%, and balance one, which is the balance on that first mortgage, is $350,000, right? And rate two, which is our fixed rate HELOC product, at 11.75%. We can go as low as 10.9% right now. And this is at an 85%, also up to 85% LTV to get that rate, by the way. Balance two, $150,000. That's our HELOC, right? So here we are. So you get the 3.5%, 0.035 times $350,000. So your interest expense on that 3.5% first mortgage is $12,250. And then you get 11.75, or so 0.1175 times $150,000 equals $17,625. You can see why they don't want to refinance that first mortgage, right? I mean, don't swim against the current here, right? You got to go with the flow. It happens to be in the best interests of the customer, unless they really want, to refinance everything for whatever reason. But now you add them up, right? So it's $12,250 plus $17,625, and you divide that by the total loan amount of $500,000. Gives you a blended rate of 5.975%. Now that's pretty remarkable when you look at it. But this is just the power of the proportion. People think about that number, but they really have to look at what's really is the effective interest rate here, which is 5.975%. That's what's leaving out of your pocket, right? And that number looks pretty good. Actually, if you could tell somebody, I can refinance you right now to get you 5.975% interest rate, and they're going to say what? And you're going to say, yeah, let me show you how. Do you think you would pique their interest now if you're telling them, I'm going to refinance you and your effective interest rate is going to be 5.975%? And they're going to be really interested in talking with you.
And when the news is all about 8%, right?
Right. But you're breaking it down in a different manner. But this is, 1 + 1 = 2. This is not salesmanship. This is consulting them. This is doing some financial analysis and enlightening them and putting it in a manner so that they can say, hey, wait a minute, you're right. That money in my effective rate will be 5.975. That's a pretty good deal. Now you have their interest, and you haven't even gotten to the best part, or just adds frosting to the cake. But just want you all to understand the formula, how it is, how you break it down here to get the blended rate, which in essence, you might as well call that what it really is. It is the effective interest rate. That is what they are paying for the combined loans with an S. So now we do our blended rate analysis and we talk about break down the savings, right? Does it save the borrower money compared to getting a new first mortgage for the full amount, right? For the 500 grand. So if we say they get 8.75% rate, let's say it's going to be, maybe, non-QM cash out, right? Something like that. And the interest expense on a yearly basis there is $43,750, right? The new second mortgage, we actually, the math is incorrect there. The new second mortgage has an interest of 17,625. I transposed my numbers. Excuse that. So the savings is still going to be 5,000, about $8,800 less interest, combining if they have the blended rate there, as opposed to a new first mortgage of 8.75%. If they have that 5.75% interest rate, they're still lower. There's still some savings there, and that's the key. And then on top of that, we have lower closing costs. Something else to consider there. Additional factors. The second mortgage, the new second, whichever one. In this case, we're talking about the HELOC. Going to have much lower closing costs. Just because of the $150,000 loan amount. That's one thing to consider. Certain costs are based on the loan amount, like in Florida, for example, there's transfer taxes. Georgia, there's transfer taxes based on the loan amount, and other states have transfer taxes based on the loan amount. Some higher than others, and sometimes it's going to be a substantial amount. So something to consider there, as well as on this fixed rate HELOC option, it's a no appraisal option as well. An AVM is used. So aside from less costs, there due to lower loan amount, there's less cost because there's less services being paid for as well. The borrower may have to pay off some prepayment penalties if there are refinancing a first as well. This option that we have does allow for investment properties, as does the HELOC option that we also have allow for investment properties. So, they may not want to have to pay. So that first off, if they're going to have a prepay, so an additional benefit you're going to be giving to them as well is that. We mentioned the amortization table, how that first mortgage can stay where it's at. Every payment that they make, there's a betterment. Let's say it could be like $1 a month switch, right? So every month it's $1 more to principal and $1 less to interest every month. That happens on the amortization. So something else to consider. You could even go and print out an amortization of where they are and where they may be, as further showing them, hey, this is in your best interest to keep the first and get the second, because look where you are in your amortization versus starting all over. So a lot of things going on. And then obviously we mentioned different product offerings depending on the income consideration. But we have them all. We have for full doc, P&L, bank statement, DSCR, primary, second home, and investment. So there's nothing holding back doing a second other than the borrower qualification. And now with the blended rate analysis techniques, you can better serve your customers, be a consultant, and gain their business. Now, this is an example of one of the many blended rate calculators that are out there, but frankly, it's nothing better than doing that calculation for your customer right then and there, breaking it down for them and gaining their trust and their confidence and getting the deal. That's what's going to make it happen. So just understand all the different product offerings that we have and take advantage.
Let me make you big again. All right. I don't see any questions on here. Hopefully everybody understands how to use the blended,
here we go.
right?
Here we go. We got one. Hey, Michael, thank you. He's always listening and always asks good questions. I'm so glad that you picked up on the fact that we mentioned that this very unique product offering which was the motivation to get this blended rate training out again, the rate is fixed on the draw. That's the key. So you can plan on, the whole key here is plan on, pulling out as much of a draw as you may need in one shot if you want to guarantee that rate. And then at the next draw, it will be based on the rate at that moment. But the two interest rates are going to be independent of each other.
All right. And just a couple more comments came in. Thanks, everybody, for dropping those comments. And tune into our live rate show where we'll go into some of those different second mortgage and HELOC options if you want to actually see some of the actual rates. So I think we're good for today. You want to say anything else, Jose, before we wrap it up?
No, I just want to say that for this particular product, there are variable rate options depending on the origination cost. So if you pay an extra point, you can get a drop of 0.85%, I believe, lower. So it'd be 10.9%, which is pretty amazing for this product type.
All right, thank you. Well, we will go ahead and wrap it up. Remember, we do this every Tuesday and Wednesday evening, 7 p.m. Eastern, where we do a different loan officer training. Thank you, everybody, for tuning in. We'll see you next week, Tuesday, 7 p.m. Eastern, for the next episode of the loan officer training. Have a great night, everyone.
Good night,
Good night,
everybody.
everyone. Good night.